how the foreclosure works, basically, as any bank.
What you do as a lender when you go to foreclose, you have to submit your bid to your attorney for the whole legal balance. If the borrower owes $150,000 and the house is only worth $100,000, nobody's going to buy the auction. Maybe you list it at $75,000, and hopefully a couple investors will bid it up to $100,000 or beyond. The idea here is that I would have bought that note probably no greater than $50,000. If it's worth $100,000, I'm owed $150,000. I want to make sure there's some cushion there so that I can sell it at the auction and walk away with a good deal. If I don't sell it, then I'm taking it back and it's a foreclosure.
Hello everyone, and welcome back to the Path of Progress. I'm your host Alex Kononov, and today's guest is Scott Carson, also known as the Note Guy. Scott is an internationally recognized expert in note investing, host of the Note Closer Show podcast, and CEO of WeCloseNotes.com. He built a real estate business focused on buying and flipping distressed mortgage notes, and he's helped thousands of people, others, learn how to do the same. Today, we'll unpack how Scott found his path, build a unique investing model, and what advice he has for those looking to enter the note space. Let's jump in. Scott, welcome to the show.
I'm honored to be here and just excited to deliver some nuggets of knowledge to your audience out there today. So thank you for having me.
I'm excited, man. This is new for me too, so I will be with my listeners on the same level. And I hope you don't mind. We're going to ask a lot of questions today.
That's great. That is great. And I think one of the expertise of me is I can explain what a lot of people make into a complicated topic when it comes to real estate investing, basic and understand it. So that's my whole goal, is that you walk away with a better knowledge and understand the difference between notes and real estate and all that good stuff.
Love it. Listen, notes is fun and exciting, but I would like to start from the beginning. Let's start from your journey, where you come from, and how did you discover real estate in the first place?
Yeah, so I grew up, I live in Austin, Texas, but I grew up in South Texas, down by Corpus Christi, Texas on the Gulf. Parents moved to a little small town called Ingleside, so I grew up in this small town, about 5,000 people. And my dad and mom owned the hardware store. So I grew up kind of working with people at a young age, especially older than me. You know, our parents instilled in me a very good work ethic, I would say. And, always been kind of entrepreneurial from that. I was doing odd jobs, working for people, mowing lawns, all that stuff. Had friends working for me. So I've always had the entrepreneurial spirit. So when I went to college, I wanted to first major in mass communications. I want to be the next sportscaster. That's why I like podcasting, because it gives me the chance to be like that, newscaster. But end up switching majors into entrepreneurship and business, and graduated college. Kind of on that path that most people take. They go to school, they graduate, they get married, they buy their first house, and they're like, okay, off and run that kind of way. And like many people here, I read the book Rich Dad, Poor Dad, and really opened my eyes to a lot of good things, and then started really trying to learn as much as I can about finances and investing, stuff like that. Had a buddy of mine, a guy approached me who's still a very good friend of mine, and helped me kind of get into the finance space of investing and power of 70, or the rule of 72 is a financing term, and start the investing process. And we bought our first house, and a realtor came to us and said, listen, you got great credit scores, a great time to buy. Why don't you buy a couple investment properties? So we were like, yeah, why not? I said, sure. I grew up in a hardware store. I can fix everything. So we bought 2 investment properties and added a couple of renters in there, and thought we were going to be the next, landlords going to wealth. Well, we all know when tenants get laid off, it's a hard time. But when you get laid off, plus your tenants get laid off, it can be a very distressed thing.
Ouch.
So I was a distressed borrower at that point, trying to make 6 mortgage payments with a private school teacher salary, because that's what my ex-wife did, or wife at the time did. And I was doing whatever I could. We were able to get rid of the 2 investment properties because I was facing foreclosure on both of those, faced foreclosure on mine, able to modify the loan and get back on track. And for a couple of years, I was kind of, licking my wounds, like, oh, I did things the wrong way. And my buddy, who I'd worked with for a while before I got laid off, came back into the picture a couple years later, was starting a mortgage company. And he was starting it with a couple real estate investors that were traveling the country investing, teaching creative financing, creating how to create notes. They were teaching with the Ron LeGrand crowd. So I was learning all this stuff, and so for 4 years, I joined them and was basically in a class with, 500 to thousands of real estate investors every other weekend. Doing mortgages, but I was taking the opportunities, like, okay, God's giving me an opportunity. Let me try to soak up as much knowledge the second time around and not thinking that I know everything. So that's kind of what I did for 4 years. Started buying real estate is the right way on creative financing, on terms, on subject to deals, and started rehabbing some like properties, had a few rentals, started raising some capital. And then we all know what happened in 2008 in the mortgage industry. So left the mortgage industry. But for that 4 years, I've been learning about notes and said, well, now's the time because there's so many foreclosures and distressed debt. So that's what I started to do. Started contacting banks and hedge funds and started buying notes from banks, Wells Fargo, Capital One, just to name a couple of the bigger banks we were buying from. And now fast forward 18 years later, we've bought over $1 billion in debt, closed on thousands of non-performing notes on residential and commercial properties, and now are very passionate about helping other people out there because I think it's really one of the most fascinating niches that you don't need to have a lot of your own money. And it's also what I love about notes is that the deal flow always comes in if you know how to market. So that's a little bit of my origin story for Marvel fans out there, Alex.
I mean, I don't know about others. I'm overwhelmed with your story. You just started like, oh yeah, just modest one flip at a time, and you just fast forward 20 years. Here we go, $1 billion in worth of note investing. Listen, let's take one step at a time. I like how you progressed from one. You were handy. Hey, I'm gonna be a cowboy here. I'm gonna try this real estate investing myself. You fell on your face, but you learned valuable lessons. And what's important here, it didn't deter you from real estate, right? You still got excited, but you were excited, even though you got so many hits, man. I mean, surviving 2 foreclosures and actually renegotiate your mortgage. So you had this painful conversation with a bank, with a lender, and in the first place, you have to face your reality. Before you start negotiating with anyone, you have to really understand where you're right now, because a lot of people in denial usually in the situation, saying they're like, no, it's not me, it can be me. But you really faced your issues head on and you battled your demons, and you went through this process very well. And then you understand, okay, I need to bring cash flow, so you become a mortgage broker. And at the same time, you still widen your knowledge information on real estate investing. So you tried really different things. You tried flipping, you tried investing, and you hold some more properties. You understand that maybe plumbing and property management is not for you from your first properties. But tell me, during this period, before the crash, while you were a mortgage broker, what was your focus on? Did you still try to acquire your multifamily or residential portfolio, or you focus solely on mortgage brokerage?
No, that's a really good question. For a while, like the first year, I probably focused just on making money, being a mortgage broker, and education. Going to classes and workshops, networking at my local real estate clubs, stuff like that. And really starting to build a database of investors, because I was out traveling so much. Like every other weekend, I was at a different conference. And I took it upon myself to build a network of investors I could start reaching out to. So anybody I came in contact with, I would get their business card and take their information and put it in a spreadsheet, because I knew at some point I was probably going to need to reach out to them once I was ready to start pulling the trigger again after recovering from my scare of facing the foreclosures. And so I did that. I started going out and applying what I was learning and going and knocking on doors, driving by ugly houses, what we all do, sending out some letters, mailers, direct mail pieces to people that were facing foreclosure, and really started bootstrapping my real estate stuff to figure out what I needed to do to get things done. I mean, I remember walking in one of the first houses, and I walked out of it after talking with the owner. He gave me the keys, did a deed in lieu, and gave me $100 to mow the lawn too. It was a pretty thing. And then also, like one of the other ones, I walked into a house, was a hoarder house. She had 4 dogs living in a house, crapping all over the place. It was disgusting. And so you get inundated into the sexy side or the stinky side of real estate investing for a lot of folks. So I did that. And that way I felt confident when everything hit the fan in 2008, when the mortgage business dried up, that it was a pretty easy transition for me, moving from being the mortgage business to being a full-blown real estate investor.
I love it. Actually, my first property was a hoarder house too. I'm from Ukraine, and we don't have this kind of stuff there. I'd never seen it before. And TV show, I discovered it later on. So when I came in, and we had a pile of crap on one side, another from bottom to ceiling, and you have a little path there. You like trying to walk there, understand where is the kitchen and the bathroom. You can't understand. We had so many trucks from there. It's unbelievable, but we got a good deal. But that's how you cut your teeth. You learn this process, and you know what they say, the smelly houses is the best houses.
That's right. Ron LeGrand has a famous quote that says, the smell of shit and piss is the smell of money. And I would agree to that in most cases. You know what I mean?
No, 100%. It's all about the price. But listen, okay, you decided that you're going to be a full-time real estate investor. But I think you just said in 2008 you decided to be a full-blown note investor. Was it a mix of both, or you just focused on one of those since we know?
No, I mean, I already started just buying some fix and flips and other things along the way. I had some rental properties, but when, between 2008 and 2010, I really made that, I was like many real estate investors. I was dabbling in a variety of things, but I wasn't making a lot of great money. I was getting by. I was barely getting by, trying to do all these things. The proverbial quote, a jack of all trades means a master of none. And I had a business partner, and we sat down and had a conversation. We're like, what's really going to make me the most amount of money? What's the most untapped thing that I don't need to have a lot of capital to do, that it's going to give me the most amount of deal flow? I just got to roll up my sleeves and go to work. And I was like, no, investing is going to do that by buying notes. So that's what I decided literally in like late 2008, 2009. I was like, I'm just going to focus on this. I'll get rid of my other investment properties. And I just started dialing for dollars, making 50 to 100 phone calls a day, jumping on LinkedIn and connecting with the right people in the right departments of banks to get lists sent to me. And that's what I did. And I knew that there was opportunities all across the country, and I'm just in Austin, Texas, right? And so I came up with the idea, a little bit of faith. I'm like, I'd gone through a divorce, wasn't in business with anybody else. It was just, me, myself, and I, and then my dog. And so I said, let's go travel. Let's go. We got an opportunity. Let's go around. So I'm a big baseball fan. And so I said, well, let's plan this trip around the country to hit all 30 of the Major League Baseball parks and the teams. And so we wrote it down. In the meantime, Alex, I'd already started sharing like the little videos of me walking through an apartment complex or walking around a property that we were looking at buying the note on, and started writing blogs and sharing my kind of knowledge of this niche that most people didn't know about. And it started getting picked up by real estate clubs and other investors out there. And they asked me, said, hey, Scott, we saw your videos on this. Would you be able to come speak to our real estate investment club or our group, or our networking? And I'm like, yeah, I'd love to. When do you want me to come? And they were all starting to line up with cities, or in the cities with the dates that I would be there for baseball. You know what I mean?
But at this point, have you already invested in notes actively?
Oh, yeah.
You already have track record?
Yep, I'd already started. I wouldn't say a big track record, but I bought about 15 notes. I bought I bought one note in Detroit that I bought for $500 and flipped it for $1,500. I bought an a note on an 8-unit apartment complex in San Diego and flipped that for a wholesale fee of $35,000. I bought a 16 unit in LA that I flipped for $100,000. You know what I mean?
So you got your proof of concept. But Scott, we jumped right into the juice of this topic. But for our listeners, because I'm afraid we're gonna lose some people, what is a note buying? Can you just give a little overall description so we can get up to speed?
Great question. So what is a note is a mortgage, an IOU. Everybody's in the note game already. They're just on the wrong side of the payment streams, whether you got a car note, student loans, credit card, mortgage, whatever. You're in the note space. You're making payments out. Well, I want payments coming in, right? So when I talk about buying a note, I'm actually buying that debt. Usually the first lien, senior liens, either a mortgage on a house, apartment, condo, or buying a mortgage on an apartment complex, mixed use, whatever type of commercial building out there. We've bought debt on all types of property types. So when we buy that mortgage, we're not actually controlling the property. When I'm buying it, this is actually what I'm buying. If you're listening, you can't see me, but I'm holding up a vanilla folder about an inch thick. This is a loan file. This is actually what I bought. I paid $25,000 for this note on a $90,000 note in Kankakee, Illinois. Okay. Borrower still owed 90, but I paid $25,000 for it from the bank. And when I bought that note, I then become the bank. I became the lender. And I have all the same rights that a lender does. The reason I bought it so cheap, because that borrower hadn't paid in 6 months or 6 years up, sometimes. So we buy that debt at a big discount with the idea most of the time that we want to actually keep the borrowers or the tenants in place, or the property owner in place if we can, because that's actually the best bang for our buck is to actually rehab the borrower, not rehab the property. And about 60, 70% of the time, if they're still living in the property or still operating the property, we're actually able to keep them in, work out a payment plan. I can be very flexible on what we offer because I buy it usually so cheap, and that's what we do. We get them back on track for cash flow. So it leads to double-digit returns for us by being the bank. And if they don't pay, then we foreclose. Another question people often ask, well, why wouldn't the bank or the lender go ahead and do their foreclosure themselves? They will a lot of times, but foreclosure timeframes are different all across the country. In Texas, where I'm at, we're the fastest in the country, 21 days. Actually, we foreclose the first Tuesday of every month. That was yesterday. All right. But Florida could take a year. New York could take 3 years. New Jersey takes 12 to 24 months in a lot of cases. So that's what you have to do to evaluate this stuff. So banks sometimes would rather sell that debt off at a fraction of what's owed so they can get that money back and then go lend that money out. It makes sense for me because I'm now buying a deal that I'm at a huge discount below what most retail buyers, and I make my money by working it out with the homeowners. If the bars won't play ball, then we have the same rights to foreclose and either sell it at the auction or take the property back.
Good overview. Thank you so much. I think I understand. And the motivation for the bank, again, to rewind it a little bit, for the banks, because for them to have a non-performing loan and stuck with it, they'd rather have cash in hand and loan 10 times more than that. I think the threshold for them is a little minimal, cash reserve versus how much they can borrow against it. So they would rather have a little bit of something and borrow 10 times more for performing people and get this ball rolling. Okay.
Yeah, exactly. And banks too, if they've got non-performing notes, they have to have cash reserves that they can't lend out. So the more default they have, the more cash they have to pull back. It means the less profitable they are, the less loans they can make. And banks don't want to own real estate. They really don't want to own your property. They want to own the debt and have you paying on time. That's where they're the most positive. They don't like to take stuff back. If they do, it's usually because of the last resort for them in a lot of cases.
Okay, I take it. Now, let's back to your journey. Now, you said that you get on the road, you hit the road, you started looking aggressively, focused on not buying. What was the early moment for you when you said, okay, this is it. This is what I want to focus on? Because there's so many shiny objects, like you said, everyone doing so many things in real estate. I love car washes, I love self-storage, I like multifamily, and it's really hard to focus for you, for everyone. How did you focus and why did you decide to do that?
So because what's one thing in common with all those assets, Alex? What's the one thing that's in common with all those assets?
Mortgage, taxes, insurance,
mortgages and taxes. They all usually have a note, and they're all, when you buy notes, you're privy to lots. I'll give you an example. I was calling banks, calling lenders, and I got a list. And in the industry, we call it a tape, which is just an Excel spreadsheet that has all these different mortgages on it, right? My first attempt at making 50 phone calls, I get a hold of this bank out in Houston, and I was about to give up. How many people would give up after 10 phone calls and getting 10 no's? Well, I made 50, I got 50 no's. I said, well, I got an hour left before I leave. Let me make 4 more phone calls. Well, on the 54th phone call of calling this list I've pulled off of, I got somebody to answer the phone, and they had a list of notes, $5 million worth of mortgages in Houston, Texas. And they're like, yeah, we'd be willing to sell the notes and stuff like that. So I scrambled for like 30 days and put this deal together that I made. My take home from that deal was 50 grand. We made 5 points on a $5 million trade. It's 250. I had split it 5 ways to get the deal done. But I was like, that's $1,000 for every no. And I had to make phone calls in an afternoon. It didn't take me long. Yes, it took 30 days to get the deal done, but I wasn't spending a lot of time on it. I was just trying to put people together. So that was like the first, I'm on to something here. This is what I want to focus on. And the fact that I would reach out to a bank, never have to send a direct mail piece, and they would send me lists every month. I was like, this is something I just need to focus on. I need to say no to everything else and just focus on this, because I would see multifamily deals. I would see car washes. I just have to find buyers to buy that stuff. And I was like, this just makes sense for me being able to scratch that proverbial itch, but doing it in one specific niche.
I love it. And you built a relationship. Now they're sending you lists. And now you're okay. Since I already have lists, I don't even have to call. I need just to make the deal happen. I'm going to make it happen. It makes sense. But let's dive deeper into your first deal. You said $5 million. It's a pretty large amount for the first deal. I mean, it sounds like it. Do you remember some numbers out of it?
Yeah. The $5 million in mortgages that they were willing to sell, the mortgages that secured $25 million in real estate. Okay. So they sold the note at 20 cents on the dollar of what was owed. Okay. So it was a lot of homes that were in Houston, Texas, around that area. It was a company called Aegis Mortgage that was in business. And Kim was the asset manager that I was talking to. And they'd laid everybody off already except her and the president. And it was this non-performing portfolio of mortgages that had been around for about a year or less. And it was all subprime mortgages, right? And so we bought it. We ended up selling it to an investor out of Dallas because I didn't have the $5 million to buy on it at that point, right? So I was reaching out to people who were looking for foreclosures and REOs and stuff like that. And through my network of investors, that I told I'd put that list together. I said, "Oh, I'm trying to move this portfolio. Do you know anybody?" And through a friend of a friend of a friend of a friend, we were put together with this guy out of Dallas, and he bought the whole thing cash. I made
I have
my fee was we put together 5 points on it, so he was glad to pay $250,000 in commissions on his $5 million trade.
Okay. Was it a specific asset type? Or it was like just multifamily, or is it just a
It was
portfolio of single family?
It was a portfolio of single family homes at the time.
Single family homes.
Yep.
Okay. And when you say there's 5 people, why do you have to involve so many people in this deal?
Well, because I was contacting other friends and families or other investors to help with the connection. So it took 5 of us to find a guy. So, hey, if you find something, I'm glad to split commission, whatever we could do. So, I mean, most of the time you're going to only do it with like 1 or 2 people for the most part. But this is the first deal I was trying to do. So I was like, let's get this done. 50 grand to me at that time was a lot of money versus 100% of nothing. You know what I mean? And that guy ended up buying more notes from me. You know, that led to him buying a couple apartment notes that we got from Capital One back in the day. And I was like, okay, you know, I didn't have to pay more commission to the rest of the people because now we had a direct relationship. So I was like, let's get something done. However we need to get some, I'd rather have something in my pocket versus nothing. And I think that's what a lot of investors fail to realize is that hunger and that hustle, it pays off if you don't let your limited beliefs stop you from doing it. Too many times people don't want to share in the resources sometimes, and I understand that, but these were all people that I had met along the way. They knew it was a deal. They didn't have the money to do it. So we just put our brain power together. Who can we reach out to who could buy this, make a connection, and make sure everybody's taken care of along the way?
I love it. It shows the power of persistency. You're persistent. You had a goal, and it doesn't matter how many people you need to talk to. You talk to, like your phone calls, 50, 54 phone calls, just one makes sense. And you found this person. Even if it was one after another, you had one connection to another connection to another connection. It's still, at the end of the day, you had a good result, which leaded to more deals in the future. And you got your proof of concept. I mean, it's really substantial proof of concept on a 5 million note. And just let me ask you a question. Is it common to have more like portfolio notes of 5 million stocks or like 10 or whatever millions, or there is smaller notes like this 90,000 that you just showed us?
It's all over the place, Alex. I got an email from an asset manager who had 2 notes they were looking to sell because that's all they had in their portfolio to sell. I got another email yesterday from a trader who's got 6 portfolios ranging from like 1 asset all the way up to 150 notes, that we take a like. And most of the time when you got a bigger portfolio like that, you don't have to buy the whole thing. You can buy a chunk. So I'm evaluating 120 assets right now that I'll probably end up making like 20 offers on out of the 120 because those are the only ones that are non-performing. That's what I'll make an offer on. And so, yeah, you can most of the time cherry pick, these tapes from banks and lenders. Sometimes they want you to buy all or nothing. If that's the case, then you just don't buy it. But there's plenty of sources out there where you can buy a one-off note or buy a small portfolio. I don't use my own money. We use other people's money to fund most of these transactions and stuff like that. So that comes in handy. That's also another thing that people have to focus on is marketing and getting the word out what you're doing helps you raise capital as well. You can't be a secret agent man in real estate to succeed long term.
No, I agree. You got to get out there and be local. Otherwise, if you don't ask this question, no one will know that you're doing something in real estate or anything. And just and if when you need to raise capital and you just come out of blue, hey, I actually doing it for 10 years. You're like, what? I never heard of you. Like, what are you doing?
But that's the thing. That's most investors when you're starting off. You look at what money is in your checking account or your 401k retirement accounts, and that's all that you say that you have, right? Because if you're a new real estate investor, most banks are going to give a new real estate. And yes, you can get a hard money loan. You go do that. That's one thing as well. But for you to stay is every real estate investor I know, no matter how seasoned they are, how many years, and they're always looking for money, always looking for capital. And so that's why you always got to start sharing that journey, sharing the deals that you're working on. Even if you use your own money, share it. The mistakes you make, the before, the afters, the shit houses that we talk about, at the beginning. Share that knowledge base because that's what people want to see. And that prepares them to be ready to rock and roll when you do need the money. I always compare raising capital as kind of like reading the book Jab, 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 Right Hook by Gary Vaynerchuk. You want to give content, give information to your audience. And the jab, jab, jab is like, okay, here's a deal that I did. And here's another deal that I did. Or here's a deal that I'm working on. And that right hook is that ask to say, hey, I need some help. If you're interested, I'm looking for some funding now. That's the ask after the jabs.
Or even to expand this topic. Listen, I've done this deal, so it's already filled in. So you created this FOMO for people, fear of
Yes.
missing out. And like, this is done, this is done, this is done. But this one, I have a few spots if you want it. I mean, I'm not forcing you. I done already this many deals, so it's okay. And this
Yep.
is power of being public figure and talking about it publicly. What do you do? I think it's important. Now, tell me this. You in real estate, you were in real estate, so you did have some experience of managing real estate and flipping houses and some brokerage side. I understand you saw the opportunity since you were a mortgage broker. You saw such a discount and a note. And especially when they buy properties, they have to put down payment. So it's even more discount because they assume they already have some down payment for the property originally. Now, answer this question. Was there always a strategy just to flip that? Did you ever have a bug that, hey, I want to be part of it. I want to try to make even more money from this deal because there is so much cushion here.
Of course. That's my biggest goal is always to buy for my own portfolio first, to buy and hold the debt. I don't necessarily want to own the real estate. I like owning the debt, though, so that it turns into cash flow and holding it for 12, 24, 36, 60 months of continuous cash flow coming in and being a bank. That's the thing is creating, everybody's got a number, and we just created a number of what we want. And, okay, how many deals do I need to close to hit that monthly cash flow number? I wish every borrower would reinstate or start paying on time again, but that's just not feasible. And so the 30% of the time we do foreclose and take the property back. I don't want to own rentals, been there, done that, not been a good landlord. And I realized, like, listen, it makes more sense for me to sell that asset off, recoup all my profits, and then put that into more performing notes. Does that make sense?
It does. It does make sense. I mean, becoming your own bank is one of the most profitable things that possible. The banking industry in the United States, it's been really profitable for those banks. But now let's talk about investor type that you see invest in those notes. Is there a specific investor type that you see mostly benefiting from such a model, or is it just widely available for everyone?
Yeah, it's widely available. You don't get me wrong. If you have a mortgage background, that always helps. If you got some real estate experience in background, where we see people struggle a lot is people who come from like the fix and flip side. They think they're buying the actual asset, not the actual note. So you have to have a banker's mindset versus a fix and flipper's mindset in a lot of cases. Sometimes engineers have a tough time in the note business because there's so many different exit strategies. They overanalyze the deal. It's not that hard to do. You just got to, as I say, keep it simple, stupid. The KISS method. If it's occupied, then you try to work it out. If it's not occupied, then you're going to foreclose or go a different route with it. But we've had people that are like 18 years old and brand new to real estate, teach them how to buy notes, all the way up to those that are 70, 80 years old and don't want to fix and flip anymore, or tired of the toilet stands and trash outs aspect of it, and like the passivity of performing paper. So the thing is, I always say is just you got to be coachable like anything else, and you've got to understand it's a different aspect of things. You can't apply your fix and flip method in marketing to notes. It's going to cause you to overbid or overpay, and that's not going to be a good thing. Be coachable, learn it's a different strategy, get educated, and then go from there.
And luckily, you don't have to flip if you don't want it, right? Because this industry is such a wide and open, and there's so many different trades. There's wholesalers, there's flippers, there's brokers, there's, like, you name it. There's everyone love doing their own niche. And if the property you bought at a discount, you should have enough cushion to sell it later on. But listen, I think our listeners and me personally have one big question, and it's care point. If you need to foreclose, what is the you said sometimes it takes a very long time, and is it cost a lot lawyer wise and the processes?
Great question.
How do you mitigate that risk?
Okay, first you mitigate it by not buying in states that take longer than 2 years. Like I don't buy in New York and New Jersey because it takes 2 to 3 years there to foreclose. Not friendly. I don't buy in Chicago because it can also take a year or more. I try to stay to investor or lender friendly states for the most part. Now I'll buy in South Carolina, which takes a year. I'll buy in Florida. God's waiting room can take a year or more. I don't mind buying in those states because I usually buy at a bigger discount. So it's going to cost you depending on the state. Like here in Texas, it costs you about $1,000 to foreclose here because it's done so fast. If you were going to buy in New York, it could take you 10 grand or more. And most states are either going to be what's called a non-judicial foreclosure state or a judicial state. So a judicial state is where you've got to go through the court proceedings, go through court, and actually go through the foreclosure process that way. That's going to cost you, $3,500 or more on a minimum, even if it's almost done, it's still going to cost you time and a little bit of money to do that. On a non-judicial state where it's fast foreclosures, where you don't have to go through the court proceedings, you just have to basically file a notice of default, or once a borrower's 90 days behind, then go file it with the county records or the county recorder's office, and then you foreclose at the next sheriff's auction. And some states do that monthly, some states do it once a month. It just varies on the non-judicial side. That's a little bit cheaper. On the longer non-judicial states, we figure about $2,500 or less. So it's not too cost prohibitive. Every once in a while, you'll get a borrower that will drag things out. Like we had a note down in Florida. The borrower hadn't paid in 4 years. It was a $1 million home. Guy owed over $1 million on the property. We bought it. We knew that he played every trick in the books, and we expected it to still take 12 months to foreclose. Well, guess what happened, Alex? COVID kicked in, and that delayed things another year. So it took us almost 2.5 years to foreclose on this guy. And it cost us, because of all the things and all the tricks he played, about $75,000 in attorney fees. But we bought it at such a good price. We knew if it took a year or 2 years to foreclose, we're going to still be sitting good. And we still made a lot of money on that deal anyway. But we were prepared for it, because part of our due diligence process, Alex, is that before we buy, we're looking at the notes from the servicing company. Has the borrower been proactive in calling, or have they not been proactive? Have they been a pain in the ass, or have they been a good borrower? So we're literally seeing the notes that the lender has on the borrower. And so that helps us identify, okay, this could be a good borrower for a modification, or no, this borrower is being very combative. We're going to foreclose. And then, of course, I don't buy a note where an attorney is the borrower. That never goes well as well.
Yeah. And listen, I understand you're trying always to work with a owner, right? To make sure they performing for you. It makes sense for them to recover the funds and just to pay. Just, can we have a little case study here for this Florida? How much did you pay for note, if you're okay to disclose it? And because in my head, if the property is expensive, you're buying it 20 cents on the dollar, you kind of okay with it if it's foreclosed. And if it's a property in desirable neighborhood, people can actually buy this note at a full ask, right? And then you have this cushion that going right directly to your pocket. So can you please unwind a little bit, and if this is case study, if it's possible?
Yeah. So on this deal, we ended up buying the note for $440,000. Okay. They owed $1.2 million. All right. When we paid $440 for the note, the house was worth about $995,000, just under $1 million. Okay. 2 years later, the house appreciated when we got around to selling it to about 1.1, 1.2. And we listed it for 1.1 after putting about $50,000 in repairs into it. So we still netted well over $250,000 with my partner on the deal. Of course, we used private money to fund the deal. So our investor got paid 12% on what the money they put up for the purchase of the note and for the rehab, and then also for the attorney fees along the way. So they made 12% of their money. They were into it they planned to be into it for 3 years. And to them, we got out of it 6 months early. To us, we said, well, we don't know how exactly it's going to be, so let's go ahead and plan, set the expectations. It's going to take 3 years on this deal because the borrowers, and we disclosed everything. Here's what we're buying it at. Here's the value. Here's why we think it's going to take 3 years, when we really thought it'd take a year, but then COVID kicked in and we got lucky. As you could say.
Yeah, I just want to say, how did you predict? You said it should be 1 year, but you're like, just in case you put 3 years, and now COVID, boom.
Well, that's a great thing, because we could see all the court proceedings and all the things the guy was filing to try to stop things. You know, he filed bankruptcy. That will delay things 90 days to 6 months. He'd done that before. His claimed he was dying of cancer, which is bullshit. He claimed he didn't speak any English. He was just Russian. He didn't speak any English. Or no, he was Iranian. So he said he didn't speak English, but outside the courtroom, he's speaking fluent English. You know what I mean? So we had to jump through a few hurdles, but it was well worth it because we bought the note right. We did our due diligence on the front end.
Wow. And so how the foreclosure works, basically, as any bank, and some people are still new for this, you have a note face value, right? And you go into foreclosure for sale in a courthouse, and if no one's buying it, basically it stays with the lender, right? You're buying it for $1, just one extra for whatever it is. And correct me if I'm wrong.
So what you do as a lender, when you go to foreclose, you have the decision to make to either submit your bid as the lender to your attorney for the full legal balance, the full payoff amount. Well, let's just run some numbers here. If the borrower owes $150,000 and the house as it sits is only worth $100,000, nobody's going to buy the auction when you bid it up to $150,000. You're upside down. Now, if you wanted to take the property back, okay, that would make sense to do that. But if you don't want to take the property back and you'd like to sell it at the auction, maybe you list it at 75,000, and you have hopefully a couple investors will bid it up to 100 or beyond, or up to 100. The idea here is that I would have bought that note probably no greater than 50 grand. If it's worth 100, as it says, I'm owed 150. I want to make sure there's some cushion there so that if I want to, I could sell it at the auction and walk away with a good deal. And if I don't sell it, then I'm taking it back, and it's a foreclosure. It's an REO that I own, and then I can fix it up and do whatever I want with it at that.
Makes sense. And this particular Florida deal, you didn't bid on it. You just left it be if someone would buy it. But you already already upside down.
We did. We sent it to auction. We came up with an idea trying to list it at 900, or maybe it was 750. Nobody bid at the auction, and that's fine. You get those higher valued houses like that. People don't bid all the time. And it was in a gated community too, so people couldn't go in and see what kind of condition. We knew we'd probably end up taking it back. So we just took it back knowing, okay, we're in a good spot. We expected we'd have to put 100 grand into rehab into it or more. We didn't have that because it was such a nice house. We had a little bit of work, but I think our budget was like $50K is what we finally ended up spending on the rehab, which was appliances and paint and some carpet, but it was in pretty clean shape. And then we got a full price offer within 30 days. And so we were off and running and selling at 1.1.
And just the technical part of it, if you list it for sale, so technically you have to list it for sale since if you foreclose on it, right? So it's a foreclosure sale. And if you don't bid on it, basically you don't want to bid on it and no one bids on it, then you just get back the note, right? And now you can do whatever you want. Now you can sell it. Now it's your property. Yep. Since there's no demand for it, now you can offload it and sell it.
But you're the bank. You have to bid on it. You have to bid on it. So you choose what you bid on it. If you want to start it off at, say, 50 grand and let it get bid up to 100, you can bid against people. It's like a foreclosure. If you've ever been to a foreclosure auction, you'll see an attorney or, bidding against people there sometimes. And other times, hey, here's the bid. If nobody bids on it, it sells at that amount at the auction, and, that bid, and the bank takes it back. So, yeah, you always have to bid on something at the auction. You
always have to bid as a bank, and but since you already know this amount of note, you don't have to come up with all the money to bid on it, right?
You're the bank. You're not. You're doing what's called the credit bid, is what they call it. So you, being the lender, you're just bidding. You're not having to show up with another 100 grand at the auction because you're not buying the property. You're just bidding it up against people to bid. Hopefully that they'll bid to buy it from you at a dollar that makes sense.
Makes sense. Thank you for explaining that.
Yeah.
Listen, you reviewed like ton of deals at this point. You have massive volume over the years. What makes a good note opportunity in your eyes?
Great question. What makes a good opportunity is a borrower who's expressed interest in staying in the property, that has tried to do some sort of loan workout package or tried to do something with the lender. Because we see that stuff. Like I've seen files where people have tried to modify their loan for 3 or 4 years and it's never happened. And so somebody that's taking care of the property, who's got emotional equity, and where we can buy that note at 50, 60 cents on the dollar, with the idea that it's got an interest rate probably at 6% or more. Because if that's 6% and we buy it at 50 cents on the dollar, if the borrower just starts paying on time, that's a 12% cash and cash return to us. That's a great thing. We're always going to ask the borrower to bring some skin in the game so we can see a mid 15s to 20% yield on it. And then if we can get them paying on time for 12 plus months, we could technically turn around and sell that note back to Wall Street at 80, 90 cents on the dollar. So that's what we like to occupied assets in blue collar towns. Our biggest bang for the buck is going to be in that $100,000 to like $300,000 price range for the most part. Don't get me wrong, we bought higher valued assets, obviously, but we always seem to have a better opportunity of getting people back on track and keeping the house in that kind of intro buyers spot. I'm not opposed to buying in states like Ohio, Indiana, that are judicial foreclosure states, but they take less than a year. I buy in Texas is great. The Lone Star State here is a cherry on top. But one of the big things is great is that you're seeing stuff in from all across the country. So don't focus on just on Austin like a lot of investors do. They just want to focus on their backyard. Some states you can do that, other states you can't. And so I'm not as picky when I'm talking to banks and asset managers. I just send me what you have. I'll cherry pick it, and I don't take a no for an answer. Send me what you got, and then I can bid on multiple assets, with the idea that if I bid on 10 assets, I know I'm gonna get 1 to accept it. So that's the thing, is looking at more than one deal, but looking at stuff to get people back on track is usually the best bang for a buck in a lot of cases. Now, if it's a vacant property, I try to see how long it's been vacant. If it's been vacant for more than 2 years, it's usually going to need a lot more work than something that's been vacant for less than 6 months, obviously.
So basically, first step is to underwrite where it's located, trying to avoid blue states, Massachusetts, New York, New Jersey. Let them be their own states. And you know lawyers because they're making a fun ride for you. But people who cares about the property, they want to stay in the property and you want to work with them to create win-win situation and help them actually to get back on their feet. It's a very solid case. But tell us a little more. What about dark side of note investing? Is it risk investment? For example, one idea that I have, like if the property doesn't have, you take over note, but they don't have insurance or the insurance expired, like this kind of risk, that's what scares people. And now a hurricane in Florida, floods, and like you got a full package.
So that's a very good question. I brought that up. So that's a thing that we check for due diligence. Is there current insurance on the property? If there's not current insurance on the property, then we're always sending somebody to drive by the property first and foremost, okay? To make sure it's still there, got a roof on, that it didn't wash away in a hurricane, okay? Always put eyes on the property. It's part of our due diligence, okay? Now, if it looks like it's in good condition, we can put something called forced place insurance on the property, that we get our own insurance on the property. And we'll often do that through our servicing company that's handling the borrower outreach in one case. I'm not talking to borrowers every day. A servicing company's doing that on our behalf. And so we make sure, get insurance put on it. And then if we foreclose and find that there's mold throughout the property, we can file an insurance claim to protect our investment. If the borrower decides to reinstate their mortgage from our servicing company reaching out to them, then we can cancel that insurance on that asset and get a refund back. If it's in a state like Florida, we all know insurance has tripled there. I'm not buying as much in Florida like I used to. I've bought hundreds of notes in Florida. Insurance was a lot cheaper, but it's tripled, quadrupled in some cases. So we're very picky about avoiding that. Unless, of course, one thing we do, like on Cape Coral, Florida, which is supposedly the worst market out there, we're looking at stuff down there because I can buy it cheaper, but I'm figuring in what are those insurance costs, and we're reducing our bids by that amount to offset that. So insurance can be tricky. I've had to file a few claims on stuff, but for the most part, it's just getting the borrower back on track, or us paying for an insurance and they're reimbursing us through their mortgage payment monthly.
Got it. And later on, you can just add it to the ledger, your expense when it's process.
Exactly. It becomes part of their payoff if they don't pay it. Exactly. It's called the lender advance fee.
Okay. All the filing fees and everything else is going to be included there as well, I'm assuming.
Well, filing for the insurance, but not filing like the transfer document, stuff like that. That's separate. Yeah.
Yep. No, I understand. You just mentioned a very interesting thing, and I would like to unpack it a little bit. You said if you have insurance and insurance costs are high, you try to bid lower to mitigate that. Tell us about the process. You actually bid on those notes, or they have certain price and they just look for the buyer?
It varies. It all depends. One of the first things we ask when we get a list in is, what's the price? What do you want for these? Okay. And usually a lender will say highest and best. So then that's why we look at, where is it located? What kind of condition is it in? How long has the borrower not been paying? What's going on with days on market in that community? So there's stuff to look at. And how much is owed in back taxes too? Taxes can wipe you out in a tax foreclosure. So that's important to look at. So we look at all those considerations, all the risk, and that's either, when we submit a bid in, it's either a spreadsheet with our bid. Here's what we're willing to pay for this note. Provide that the balance is what it is, the payoff is what it is. And then if something comes back during our due diligence period, like the lender says, oh, it's worth $300,000. Well, we get back it's only worth $200,000. We can reduce our bid, or cancel it altogether because we're not putting up any earnest money. So that happens. We're allowed to do more through our due diligence once our bid is accepted. That's one thing that's great, is I'm usually looking at Trulia, Zillow, county records online at first to get a bid. And then there's a 30-day, 60-day process of going through, sending somebody by, look at the property, looking at the collateral files and all that stuff afterwards. And everything matches up with what was shown on the spreadsheet, then we'll fund. If it doesn't match up, then we're reducing our bid and then going back and forth and countering, or just they say, oh, no, we don't want you to, we're not going to accept your counter or fade. Well, then I'm like, okay, I'm not going to buy the note and move on.
And you usually have 30-day for due diligence?
Yeah, there's usually, if you're buying like one note, they may give you 7 to 14 days to do it, because you're still going to hire a realtor to go out and do a BPO, drive by, take photos and pull comps for you. And you're still going to order title, work down a full title report. We call it a 2-owner report, or it's called an O&E, ownership and encumbrance report. So we'll pay for that. And some areas get that back fast. If you're in Pennsylvania or rural areas, those can take a little bit longer to get back. But that's going to show all the different liens and judgments that are on the property, the mortgages, ownership changes, taxes owed, all that good stuff. We'll look at that, and that helps us determine, okay, everything is good on it, or there are some stuff that if we wanted to foreclose, we'll have to foreclose for sure, versus doing like a cash for keys or deed in lieu. We'd have to go ahead and foreclose to wipe out any liens on the property that we can't.
Okay, I have a follow-up question. What is your worst deals that you had to walk from it into diligence phase? Did you have any of those?
That was the longest or the shortest? Sorry.
The worst deals that when you went through the diligence, you bid on this package, and now you're going through the diligence process, and you're like, oh my God, this is no go for us. This is the worst thing I've ever seen.
Just happened a couple months ago. We bid on 20 notes from a company, and they sent over the collateral files, like this loan file. They sent over a PDF, not the actual file, and that's fine. You have to do your due diligence off the PDF. But there was missing documents. There was only like 4 pages in there. It had no insurance. There was like 30 grand in back taxes owed, but they had no collateral. I mean, they hadn't touched the loan in like 4 years. It was just sitting on their portfolio. So it had no notes of the borrower. They'd stopped servicing it. It was missing all these documents. The only thing it had was the original deed filed at the county, no mortgage to look at. And I was like, I'm not going to buy this note because it's missing these huge holes of ownership. I guess the note had been sold 3 or 4 times previously, and all the document was missing. So that was one thing, like, nope, not going to do it. When we sent somebody out to drive by the property, it came back like it literally had a lien on it. The house was leaning this way. It looked like Jumanji had taken over the property again, too. So we're like, it's ugly property. We don't want to buy. And that's the number one law when it comes to notes. Don't buy a note on a property you don't want to end up owning. Okay. So we just said, listen, we're not going to buy the note. You couldn't give this to me because there's no way I could foreclose on the property because all this paperwork and collateral is missing.
Makes sense. Okay. Listen, I know sub-2 question for the investment got really hot topic in the last couple of years. Have you ever had to foreclose and take over notes with people who own sub-2? So it's kind of daisy chain of owners.
Yeah, we've done that. We'll see that happening, and we'll usually know that on the front end because when we buy a note on the spreadsheet, we'll give the borrower's name. So when we go to the county to make sure ownership matches up, we'll see that property's been quit claimed over to an LLC or somebody else. And so we'll know, okay, this is who we need to reach out to either start paying on time. And we've seen that where people have taken over via subject to and not paid the underlying mortgage, which is shitty of them to do that, right?
Yep.
And so we'll foreclose. I mean, we've allowed borrowers to let somebody take over their payments too. It's something that we can allow them to do. I can allow a borrower to assign their mortgage to somebody else to come. It's not a new mortgage. They're taking over the existing payments. But yeah, we can allow that. I don't mind if it's a sub-2 deal, but if they're not paying, pay, stay, Now, here's another, let's flip the thing here. We get these lists in from banks with all the information, the interest rate, the payment history, how far behind they are. And so if we can't buy these notes from these banks and lenders at the right price, if they got a low interest rate, we target the borrowers for subject to deals as well. So we'll send out our own direct mail campaigns from a different LLC, different entity, say, hey, you're losing your mortgage. We would love to help you stay in your house or help you avoid a foreclosure, take over your payment subject to. So we will kind of approach it, both sides of the equation or bookends of that deal. We can buy the note, great. We can't buy the note at a price that makes sense. We'll try to do a subject to deal and market to them directly.
Wow, love it. So you're really trying to help the other people to stay afloat, even not only from buying side and being a lender, but also being a transactional there. I think it's really good. Okay, listen, and I have one just to finish the cycle of questions. What is your best deal, Scott?
I would say the best deal here is where you really help somebody. I mean, we've helped hundreds of people stay in their houses, and that's always a good feeling. We helped a single mom with 4 kids in Cleveland who owed like 30 grand on a house I didn't want to end up owning, and she was going through dentistry school or be a dental assistant. And so we actually forgave her of her proper debt. We literally gave her the mortgage. Listen, you don't own anything. And I paid $1,000 for it. It was Christmas time. I was like, listen, I'm just going to give it to you. I'll write off that $1,000. You can keep it. I mean, we've helped people who have lived in houses for 18, 20 years, who are, facing foreclosure because it wasn't anything bad that they did. The market kind of crashed a little bit, or one of the, like this one couple, the husband had a heart attack and was out of work for a while. And she'd been trying to modify her loan for 4 years. And when I got her collateral file sent to me, there was all these letters in here where she'd been trying to modify. I mean, it was literally a huge file. tried to, and her loan had been sold 4 times. And I'm like, well, she's telling you what she can afford right here. The numbers make sense. Let's buy it. We worked with her, called her up, got her on the phone, said, listen, can you make your existing payment? Yes. Okay. Can you bring a little extra skin to the table? Yes. Okay. You do that for a year. At the end of the year, we're going to forgive some balance on your loan. Anything above what you're actually, the value of the property, we're going to forgive. We're going to drop your interest rate to 0%. So you can now, every dollar, every penny you make towards the mortgage is going to principal. You'll be paid off in 6 years versus 30 years. And it's a win-win there for you. And she was just, they cried on the phone, and every once in a while I've had somebody name a kid after me, not because I was doing anything, but because we helped them stay in their house. And whenever you get those letters or phone calls or emails from borrowers that you've helped along the way, that is the best thing that you can do. Second best is when we get our students that call us up and say, hey, I just closed on my first note deal. I'm making $500 or $1,000 a month in cash flow, and I'm able to help people stay in their houses, or I got a deal that, never thought I would find anywhere else. Those are amazing things. And that's why we teach. That's why we've got the podcast, is to help others achieve that type of success. It goes back to me, facing foreclosures, 20 years ago. I was like, God, if you can help me get out of this situation, I'll try to help anybody else I can along the way. And that's kind of what drives me.
I love it. Giving back to the community in a meaningful way. I hope, Scott, you actually print those and frame it in your wall. You have a wall of, those gratitude. No, I think it's important to acknowledge it, and you're doing a great job. And thank you for doing that. I really appreciate it, because everyone has a different situation, and you actually taking the time and reviewing those files and making a difference in this world. This is great.
Everybody goes through financial hiccups. It doesn't matter. Everybody's going to have a period where they are behind, they have lost their job, illness, a deal goes south. I mean, heck, you and I know a ton of apartment syndicators out there who are struggling. Doesn't mean they're bad people. It just, there's a way to do it. I struggle right now with banks because I really am beating my head because the banks are like trying to keep these multifamily deals at one price when the value's down here. You've got to negotiate. You got to start working things out a little bit there. And sooner or later, we're going to see a big difference. And more of that stuff hit the market these days, the commercial side at bigger discounts. But there's ways to help people if you can just be a little bit more flexible and understand what's going on.
Yeah, it's powerful. I think it's important for listeners to be there. It's not only one side of monetary gain, but also doing something meaningful with your work and helping others along the way. It can give you actually much more revenue and much more benefit in the future. Not to look at this particular moment, how to make money, but in generally speaking, helping community, and community will help you back. It's powerful. Listen, I want to switch gears a little bit, and we touched this a little bit about your podcast, but I want to expand it a little bit and to ask you a few questions about it, because you built not just a business of note flipping, right? You just built a full ecosystem, education, podcasting, and community, which is quite impressive. What inspired you to start teaching note investing in the first place?
So I was getting these lists in from banks and lenders, and I didn't have the money to do it. And when I started talking to investors who would fund my fix and flips, they were like, I don't understand the note business. So I had to start teaching to educate people on what a note is and how you make money with a non-performing note. And so that's why I started teaching, was just to educate people on how this opportunity. I had one of my private funding partners who made a lot of money in the 80s here in Texas when we had the big savings and loan scandal, the Resolution Trust Corporation, where all these banks were failing at that point. They made a ton of money at that, but he couldn't fund everything. So I just started teaching people like, hey, here's how we break down, and you get a list of 200. Let's break it down to the top 20 that we want to buy. And nobody does that. Nobody's going to take time to go through a list of notes. And we're one of the probably the only people that will do it on our podcast or on our YouTube channel. And it gives people an opportunity to kind of see over my shoulder what I'm looking at, walk them through the process. And that's an important thing. I mean, our podcast is about 50% of the time me going through a niche or nugget or a deal or case study. The other half is usually me bringing on an expert in some field that assists with our note investing. Sometimes it's marketing, sometimes it's business, sometimes it's mindset, but most of it's to help them make more money in their note business. And we're pretty excited. We just, we're recording our 1,000th episode this coming Monday on the podcast.
Wow.
Yeah.
Congrats. So you've been doing it for quite some time. So how many students you have roughly to date?
I stopped
lives you touched.
I've stopped keeping count. I mean, we've helped hundreds and hundreds and hundreds and hundreds of people buy their first note. I'm very blessed that we've got, I know that especially our coaching students have closed on thousands of deals. they've raised millions in dollars and helped a lot of people stay in their houses. And we have influenced a lot of people out there. We're one of the only people teaching on the note how to buy notes. I know I'm one of the few, only person teaching how to buy bank notes, and one of the few people teach about non-performing notes. And we show you how to find, fund, and flip these things. It's not as difficult as most people make it. Banks will sell you notes. You just got to know who to talk to and be talking and know what to say. Now, you're not going to go buy from Bank of America, Chase, or Wells. They want you to buy $50 million, but there are plenty of other lending institutions out there. And to give you a bit of an insight, there's basically just about 5,000 bank licensed lending institutions out there who are chartered banks. There's about 20,000 other types of lenders out there on the mortgage side. So there's a lot of notes being created, and a lot of opportunity. Not all these lenders or banks are keeping their notes. They've got to move them off their books. So it's plenty of opportunity out there. If you will just pick up the phone or jump on LinkedIn or start doing email blasts, it's one of the easiest ways to start finding deals.
And are you specifically on the real estate notes focusing?
Yep.
Okay, makes sense. Now, big question, and our listeners have this question too, I'm sure. Since you created thousands of students throughout the years, isn't it too much competition? Right?
I get that all the time. No, it's still such a niche. There's maybe 40, 50,000 note investors out there, which is a fraction of your fix and flippers, your wholesalers, your landlords, your apartment investors. It's a smaller niche out there than any really other stuff out there. There's a few others that are smaller niches, but it's still a very small niche of notes because there's so much opportunity. Now, what you will have people say, oh, there's too many note investors, can't find any deals. And those are coming from people who don't market. They get one or two sources that send them notes, and that source stops sending them deals, so they don't go market for stuff. That actually, it really pisses me. Now, I'm not pissed at you, but when I hear somebody say, oh, there's too much note investors, that's a bunch of bullshit, right there. That's coming from somebody who's probably never sent an email blast to a list of asset managers, never jumped on LinkedIn and contacted the right departments, or worst case, picked up the phone and dialed for dollars to find the right asset managers, these banks. And that's one of the things that we teach is literally how to find these deals direct from banks. It's not difficult. You just got to be like anything else. You've got to market for it. Sending out thousands of postcards, you're marketing like it's the 21st century, not like it's the 18th century.
You keep saying asset managers. In my head, a multifamily space asset manager is someone from owner operator. But you're saying asset manager is from the bank representative, lender representative?
Yeah, so basically there's four titles to buy notes, people that handle banks. So your big banks are going to have something called a special assets department. Okay. So you're going to speak to a special assets manager. REITs and some of the medium-sized banks are going to have something called a secondary marketing manager. All right. That's the person in charge of the secondary marketing, moving notes from the first primary market to the secondary market. You're going to have smaller banks that are called, they have a chief credit risk officer, may even be the loan officer that originated notes with small banks. REITs, hedge funds will have something called a whole loan trader who's in charge of loan trading. Okay. So you can literally go to LinkedIn and type in those 4 job titles, and you'll find a ton of people that are in that space. And that's all about just reaching out and following up with the people to find the right person in the bank. That's your first starting point, is reaching out to special assets manager or secondary marketing manager. Don't call the bank and ask to talk to loss mitigation or the REO department. They're not going to talk to you. But special assets or secondary marketing department, those are the guys or gals that are handling the note sales for that lending institution.
But we have a little crash course on note investing here.
Well, if you'd like a real crash course, we've got a 1-day class that we give away to help people dip their toe in the water. Doesn't cost anything. Don't even need a credit card. If you go to noteweekend.com, you can take, it's like a 3-hour course. It's a Cliff Notes version of my weekend course, but it's a ton of knowledge on there. People tell me that we give more knowledge in 3 hours than most people will give you in 3 weeks. All right. Because I'm not blowing smoke. It's not a pitch fest. It's literally designed to show you how to find, fund, and flip these deals and how we do it.
So if someone's still listening, guys, this is a golden nugget right here. We're going to leave this in description for you, for easy to find the website. And I appreciate you sharing that. Thank you so much. Yeah. I want to talk about your students and the mindset shift a little bit more. What are the biggest takeaways on the students' experience once they got into the space?
It's kind of like that little Thomas the Tank Engine. I think I can. I think I can. I know I can. I know I can. You know what I mean? I don't care if people are buying a $1,500 note or a $50,000 note. It's that aspect. I hate the word proof of concept because note investing has been around forever. Banks have always bought and sold notes, and the concept has worked fine. But I say instead of proof of concept, I say a proof of belief that they can do it. Because most people say, oh, you can't buy notes direct from banks. I mean, I've literally been called the devil you're Satan, you're lying. I'm like, no, you can buy notes from banks. Here's the proof. You know what I mean? And that's the thing is understanding they get their first list in and they make an offer and they get it accepted. Like, oh shit, what do I do now? And we hold their hand through the process. Or they, like they need money. Like, I can't buy anything because I don't have any money. Let's have you start targeting IRA investors. Let's show you how to find people at the county who have bought a note with their IRA or funded with their IRA. These are great people to reach out to. So it's just showing people that they can do this, and it's a repeatable, a rinse and repeat kind of systems to get rock and roll. It's not that hard. I mean, everybody's capable of raising $1 million in the next 90 days. I'll bet my life on it. And everybody's capable of buying their first note in the next 90 days or sooner as well.
And what's important, like you mentioned, is to create this predictable result. And now, since you tried it, now you kind of, after a few notes flipping, you get this belief that you can do a predictable result on.
Well, but what's also different too about note investing too, Alex, is most people that get in the real estate side not only have to find a deal and then fund it, but they're also the subcontractor or the contractor or the marketer. Ugh. Okay, when we buy a note, yes, you have to go find it and you got to raise capital for it. But then you turn it over to servicing companies who handle most of the heavy lifting. If the borrower's not going to play ball, you put it with a real estate attorney and they handle the foreclosure process. And then you sell it, or you find a realtor to list it for you. You don't have to go do it all yourself. And that's one of the biggest things that people love about notes. It's not 100% passive, but it can do this from anywhere in the country. I'm in Austin, Texas. I'm buying in 20, 30 states. You know what I mean?
You have less points of failure. Because in the other ones, it's transactions, in your traditional real estate, you have so many moving pieces. Contractor overcharge, market tanked, something changed, something happened on the neighborhood, something blow up, some meth lab, whatever it is. People stop moving out.
What neighborhoods are you buying in, man?
That's a crazy story. I just recorded a podcast with a big syndicator from Columbus. And he said that before that he was investing in Utah. In Utah, when you buy a house, you actually have to test for the meth. It's actually one of the buyer's due diligence. I never heard it, but it's actually very toxic, apparently. And the buyers actually have a special person dedicated to hiring a subcontractor who will test it. And if it's tested positive, you have to hire another subcontractor to scrap it. That's why I'm like, it was so fresh in my head.
Yeah, you literally have to take it down to the studs and like season the studs and seal those and get rid of the wallpaper and stuff like that too. Yeah. If we see something like that, we're like, yeah, we're not going to buy the note unless we're getting it for cheap, or it's going to be given to us in a lot of cases. You know what I mean?
Yep, love it. Listen, I wanna real quick touch a little bit about secret sauce of nowadays, of condition of your insider information as it being in note investing for so long. What are you seeing today in market, and when it comes to opportunity to note investing in general?
Much more opportunity. Now, the thing that we track too, we're 6 to 12 months ahead of most retail buyers. Okay, most investors are looking for foreclosures or REOs. Well, that's 6 to 12 months removed from when we're buying stuff. That's why we're buying it further, closer to the source and much further up the pipeline. All right, and so we are able to see things differently. Like, I track foreclosure sales, I track foreclosure default rates all across the country. So, like here in Texas, we just had a record month in Texas with over 4,400 homes going to foreclosure. That's more than it was a year ago. And the numbers don't lie. With defaults going up across the country, you get more foreclosures. But the biggest thing that banks have figured out is that they would rather sell the debt to an investor versus have to take the property back. So that's why you're not going to see this huge foreclosure tsunami of REOs. Most of these notes are going to get sold off to investors like me. They're going to buy it at a discount and either work it out, something, cash for keys, or take the property back ourselves and then, fix it up and sell it. So we look at default rates. We look at where things are failing. I'm not going to paint a rosy picture for the United States here for the next 12 to 24 months. All our economic data that we track, all our default rates, stuff like that, shows, like right now, the United States has the biggest surplus of homes versus buyers than we've had since 2008. Okay, there's over a half of, and this is just actually new build inventory. There's 500,000 new build homes sitting out there that are just builders can't move. Okay, you've also got a lot of defaults and stuff like that across the board. So I'm predicting, based on our numbers that we see, that just about every of the top 900 cities across the country are going to see a 10 to 40% reduction in values in the next 12 to 24 months. That leaves a lot of
Wow.
opportunity for note buyers to come in and buy it at big discounts and have the flexibility to be able to hold that for a period of time while the market rebounds, and or sell it at a price point to somebody that makes sense, or drop rent so they want to keep as a rental to offset their costs when the markets drop. So it's not going to be a great picture in a lot. Some cities will be hit very hard. Others are going to see a bit of a drop. It all vary neighborhood by neighborhood, but yeah, it's literally 10 to 40% depreciation basically. And if you like, Alex, I can actually send you the spreadsheet that we pulled with all that information for you to talk about if you like.
I would love to have it. And listen, just a few takeaways from here. One is like analogy. You like this forest workers that you putting out little fires. You otherwise, if you won't be in the picture, there will be like a huge wave of foreclosures, and it's just gonna be tsunami of price reductions. Now you kind of take it bit by bit, and you make it less. You kind of flatten the curve here, which is helps drastically, I'm sure, for the general population to absorb. And on the other side, I feel like it's a so biggest takeaway. It is a good time to start note investing.
So a lot of people are like, when's
time
the
like this doesn't take often.
Exactly. So I had people that are like, man, I should have been a note investor back in 2008 to 2010. I'm like, yeah, that was the best time. 15 million homeowners, and one of about every 11, 12 commercial deals was underwater or in distress. It's not quite that now, but we're going to probably see it get to halfway there, I think, based on everything we see. So, hey, it always pays to be the bank, and that's why I like it. We get more deals sent to us, bigger discounts, and better ROIs without having to actually own the property. So it's not as difficult as you make it. It's a different niche. You got to learn anything about note investing like anything else, but it's definitely a niche. It's a very profitable niche. And like I say, I call it the sexy side of real estate.
Very good. But listen, you mentioned Texas, and any other particular regions that you track in that you would like to focus on, or even asset types? Because I know commercial mortgage have a huge wave of delinquencies nowadays. And is there anything in particular you're bullish on right now?
So small balance commercial, 5 million balance or less. That's a very big pain point for lenders and banks. Now, Wall Street likes the larger 5 million and above balances. It's worth their time to use probably 10 million and above. But this time around, to this crash, most of the commercial debt was financed by 70% of the local banks. Okay. And it was all small balance stuff usually in a lot of cases. I mean, there's some big stuff, but for the mostly small balance. So that's a huge opportunity. We're starting to see an increase in multifamily that are 100, 200 units or less, starting to hit the markets where we can buy that debt at a discount. Some lenders are still a discount. There's still a gap between what we want to pay it for and what they think it's worth. But we're starting to see that gap get narrow and narrow. So that's the biggest opportunity, I think, in homes that were built, the rent to own communities, the Airbnbs that were built up. We're seeing a ton of that DSCR debt come across our desk that we can buy at a discount. Buying at a discount still may mean where it's only at value right now, so there's still a bit of a gap, but lots of opportunities in some of those markets out there that were big for that.
Okay, one of the biggest questions for someone just starting in 2025, they decided, listen, I love what this guy's saying, and I listened to his course. Where do I start? What do you think would be a good start to explore note investing seriously?
If you're going to be serious about it, know where you want to buy, pick 3 to 5 states, and buy your first note. It doesn't have to be $1 million note. It could be a $25,000, $50,000. Get the systems down, the concepts down, because then you can really raise capital or put your money to work on it. So go buy your first note. There's plenty of great yields on a performing note or a reperforming note. That could be 12 to 15 yields. Buy that, learn the aspect of things, and then go to work to do it. But get outside your neighborhood. Like if I was just in Austin, Texas, trying to buy notes in Austin, Texas, I would have gone broke a long time ago. Expand your knowledge. Like if you live in California, don't buy in California. Buy in Arizona or buy in Missouri. If you're in New York, don't buy in New York. Some people buy there. That's forever stupid. Buy in Florida. Buy in North Carolina, South Carolina. There's plenty of opportunities out there for you to find some great deals. And you don't have to do all the work. Send somebody out to look at it, pay a realtor, do your due diligence, and start cashing in on the passive cash flow.
Now, I also mentioned that there's a timeline of next to 10 to 24 months will be the biggest opportunity for that front. Now, if you're buying just one note and want to try it out how it works, foreclosure going to take you a year, and the process can take a year with one note. Would you think you have to be more aggressive nowadays since it's just a window of opportunity? Maybe
No.
makes more sense.
That's okay. Let's take that down. The biggest amount of defaults is going to be in the 12 to 24 months, but things don't always work out smoothly in 12 to 24 months. All right. So like we thought back in 2010, we thought it would only be like a 4-year market for distressed debt. Yes, the peak was at 2015, 16, and 17, but there's always distressed debt out there. So the whole idea here is buy it. If you're not always going to foreclose, so buy it and turn it into cash flow. If you get it reperforming, go buy the next one. Yes, if you're going to foreclose in a longer foreclosure state, that's one thing to do. But it goes back to raising capital. If you know it's going to foreclose, it takes 6 months to foreclose, great. Go raise some more capital, go buy more notes that you want to do. The biggest mistake I made early on, Alex, was buying notes and foreclosing on everything. That took time. It took money from attorneys. It took servicing costs. And then I'd have to repair the property if I didn't sell it. If I look back now, and I'm honest with myself, probably about 80% of the notes I bought, I could have modified or kept the borrowers in and made more cash flow immediately and faster instead of having to wait for the foreclosure process. Some I had to foreclose because it was the only option, but a big chunk of them, people wanted to stay in their house. I could have worked with them and made more money and higher returns with a whole lot less work.
I think it's very important, right? Yeah, it's not only about foreclosure. It's like when you have a tenant analogy and when you have to evict them, sometimes maybe it makes sense to work out the deal with them, payment plan before going through eviction. Because if you go through eviction, you already have this $400 lawyer fee you already put it on them. They get a pressure hit and they get stressed over the losing the situation, and now they most likely they will stop paying at all. And now you lose this payment for like 4 months instead of you just trying to work it out, maybe some payment plan, and they float in until they catch up. I think there's a lot of logic here and makes sense.
Totally agree.
Okay, Scott, I have only the last few questions for you. Quick hits, lightning round. So whatever first comes to your mind, please let us know. One book or resource that helps shape your real estate or business mindset in general.
Talk about business mindset. I would say The E-Myth by Gerber. Now, that would be one of the big things of trying not to do it all. The E-Myth talks about how most entrepreneurs are wearing 3 different hats, and you're not good at all 3 hats. You're usually good at one hat. So that's the idea. Find out which hat you're good at and then outsource the other 2.
Wow, love it. And it comes back to your sin, and that there's less point of failure when you just do one thing and you have less people to delegate it to, which aligns with your note investing strategy. Okay, very good. Most important trait for a successful business owner?
Coachability and the ability to ask questions. I think business owners out here, we think we know it all. God knows I did. You think, well, I know it all. I'm just going to work my way through it. If I would have been just humble and put the ego aside and ask questions, I probably would have saved a whole lot of errors along the way. So surround yourself, find you a mentor, find you somebody you can ask questions of, because most people are glad to answer questions. They don't want you to go through the same hiccups that they went to.
I think being open-minded correlates with that. You just be open for opportunities, possibilities, and don't say right away, I know what it is, because most likely you don't know all the details and no one knows everything. There's always something new we learn from this. I'm sure even you in Note Investing, you face some situations that okay, this is something new.
Yep, it happens all the time. Happens all the time. We had that, it had that happen on a deal in Pennsylvania just recently. I'm like, well, that's new. I hadn't heard about that. So things are changing.
You live, you learn.
Yep, amen to that.
Yep.
Amen to that, brother.
Love it. Okay, one thing you wish you had known when you were just starting?
The one thing I wish I would have known when I was just starting as a note investor or as a real estate investor?
As a note investor, this is your niche, note investing in general.
Make more offers. I wish I would have known to make more offers immediately versus just cherry picking like the one little note that I could afford. I wish I'd have made more offers. I look back now, I wish I would have bought a lot more stuff 10 years ago than I had, because you're like, oh, that was such an opportunity. So that was one thing. Make more offers and don't be afraid to make 10, 20 offers, because you have a lot more likelihood of getting something approved if you're making multiple offers versus just making one.
The keyword here is the volume.
Yep.
You add the volume here, you get some heat on, and instead of on 100 notes, if you win 2, then it's your 2, but they're like home run deals. Yep. Because you already send offers that are going to make sense. Yep. Instead of just underwriting 2 and both of them not work out, and it's just what you're going to do. Love it. Scott, I have one last question for you. If someone wanted to know about note investing or your journey, how people can find you?
Really easy. You can go to our website, weclosenotes.com is the mothership where everything's at. We've got our podcast, the Note Closer Show. We've got the YouTube channel, We Close Notes. Those are both #1 in their categories for note investors out there. We've also got an AI clone we just launched 2 days ago, too, that takes all of our library of knowledge and put it in one spot for you to tap into. So check it out, website, weclosenotes.com. You can always book a phone call with me too to pick my brain at talkwithscottcarson.com. And like we talked about before, if you want to get started, go sign up for the free class at noteweekend.com. But most importantly, if you're listening to this show, Alex is doing a great job. And this is podcasters. We'd love to hear from our audience. So make sure you hit that subscribe button and you make sure you leave Alex a 5-star review. All right. Do so. We love to hear from you. Ask questions. Share this show with one person you think would find it interesting. And most importantly, go take action. That's the biggest thing. Take what you've learned here and apply it and go take action.
I think you said it right. And thank you so much, Scott, for coming in today and giving us a brief overview, like a really crash course of note investing in a short time of period, and sharing your ups and downs and your stories. It's really interesting to see how you progress on your own path of progress and become who you are today, and inspiring others and helping communities along the way to stay afloat and work the deal and stay in their houses and keep the American dream running.
Amen to that, brother. Amen to that. Thank you for having me on. It's been an honor to be here.
So much. And for everyone else, as Scott said, feel free to subscribe if you like the show, and stay focused on your journey, stay intentional, and keep moving forward. To the next time.